numbers. Let's move on. We have joining us in our studio Diviya Nagarajan, Head of Research, India and APAC Regional Products at UBS. Diviya, thank you very much for joining us today.
Happy to be here.
You know, we are at a point where macroeconomic numbers or geopolitics is hitting us much more than the earnings growth. How do you look at the Indian market from that point of view?
So I think the markets have been quite resilient, to be honest. I think our global head of strategy, Bhanu Bhaveja, has been telling us that the markets are so used to buying the dip. So he was willing to say that it's a very likely scenario that that would happen again. So we've seen that happen again this time. And the SIP flows in March, I think, are very, very telling that the market is clearly looking at opportunities to buy the dip.
And how do you look at earnings growth? Because we started off the financial years expecting a 15% growth in earnings. Now it's been tapered down to below 10%.
So I think the way to think about it is that there's definitely demand destruction that's happened in some areas. I think the government has been trying to ease the situation to the extent that the government can. However, we are an oil importing country, we are a gas importing country, and therefore to some extent there has been some demand destruction. So if you look at some numbers that have come out recently, you can see early signs of that demand destruction. But that being said, overall, the numbers are still reasonably healthy. We are not looking at things falling off a cliff yet. The worry I would have is that if you look at what my economist is saying, our base case growth scenario for this year now is 6.2%. If things recover quickly from here and the blockade is removed, we could go up to 6.5. But if you get a kind of a combination of bad events where this goes on for longer, and then we have a bad El Nino that impacts crops, then we are looking at a downside scenario of 5.5. So I think we are hoping doesn't happen, but that's the range of outcomes that we're really looking at.
You know, at UBS, you believe that India is one of the most exposed Asian economies with respect to oil price impact. And, you know, the Strait of Hormuz effectively closed. What is the likely impact you spoke about the earnings on the economy, but on the earnings front, actually?
I think it's a little bit challenging at this point to talk about earnings per se, because it's going to be very sector dependent. It's going to be also very dependent on what the government could do. So one of the things our economist Tanvi Gupta Jain said this morning is the fact that the currency has been, as you see, depreciating. That's kept foreign investors away. It also has impact on importers in terms of earnings. So there are multiple moving parts for us to safely say this is going to be your earnings downside. It could be the risk is exponentially to the downside the longer this takes. However, if the government puts in some measures to stabilize the rupee, they've also already stepped into stabilized demand, then you could see some impact being mitigated.
Right. And Diviya, at what point do crude prices become challenging to our balance of payment structures? Any adverse effects over there?
They already are. I think
Absolutely.
we're kind of at the point already, which is why I think we expect that the government could offer multiple measures. So one of the things they could do is probably put a little bit of a temporary curb on the remittances that go out to foreign countries. They could look at NRI deposits again. They were very successful a few years ago. So there are measures that they could put in to kind of prevent that from happening. But as things stand, we are looking at north of a $50 billion kind of a balance of payment issue.
And what happens to the entire OMC basket? Because recently we've heard comments from the government saying that as of now there is no package or a relief package that's at least in the works for OMCs. On one hand, you've got crude prices that are really volatile. How does that impact OMCs and their financials back home?
So I think there is a balance to be maintained between passing it on to the consumer and inflation versus how much pain the OMCs can take. And I think the government has already allowed almost up to 3.9 rupees of increase to be passed through. So we think that our analyst Ribu, he expects that there will be staggered increases that will be allowed. But is there a big bang relief package that we're expecting? That's not our base case.
Maybe how do you look at the rupee depreciation? As we speak, it's heading to close to 97. There isn't much of intervention which is coming in, and RBI is holding on to that intervention for now because of the kind of global momentum which dollar has. How do you look at rupee depreciation and its impact on Indian companies? I mean, IT is a beneficiary, but from an import point of view, it's creating more challenges.
So, which is why we are hoping that the LRS is a way that they can curb. Last year, I think we had $30 billion worth of outflows through that scheme. I think when we had the NRI deposit scheme, there was a similar amount that came in. So, some of these we are hoping will help stabilize the rupee in the near term. Our end of the year target for the rupee is still 96. We're slightly above that right now. But our view is that if those measures that we're anticipating don't come and then the oil continues to remain elevated, then we could be looking at 100 in the near term.
I was just going to ask you that. Do you at any point see the rupee heading towards 100?
Yeah, like I said, if those measures don't come in, then there's a temporary risk that we get to that point.
Absolutely. And let's talk about the banking and financial space. You know, lots of analysts that we interact with are still largely overweight on that sector. Talk to us about what is leading to the kind of resilience that we've seen. On one hand, you've got earnings, but do you also believe that at this point, the market is not factoring in the risks that could be seen in the sector in terms of unsecured loan books or asset quality or anything that you would be watching out for when it comes to financials?
So the reality is that we were just coming out of a bad cycle and we were starting to see a good upswing build on the banking side. So I think the way our banking team would characterize it is that if this had happened a year ago, it would have been a lot more difficult to handle then. I think so the banks are in definitely a better shape to handle this. Banks are also typically, at least in a theoretical sense, better prepared to deal with inflation. So it's a positive thing there. However, I think in the short term, I think we've seen how the FX curbing, the government has tried to curb speculation. Some of that could have negative impact on the balance sheets. But beyond that, I think it is actually one of the better times to have had a crisis like this than, say, a year or two ago. So I think part of the resilience is because of that. Of course, we would worry about second order, third order impacts, NPA formation again, if this lasts for a really long time. But at this point, we'll have to wait and see. And to your point, the part of the resilience is coming from the fact that the banks are in a better shape right now than they were a while ago.
What's your preference, PSU banks or private banks?
Private banks. I think that's a bit of a consensus view. I think it would be private banks, yeah.
Because PSU banks have outperformed the private banks in the near term or maybe last 1 year or so. They're holding good books. The loan to deposit ratio is also handsome for them. They've been able to expand that pool as well. Why is that foreign investors are still looking at private banks and not PSU banks?
Well, foreign investors, I would say, are not really looking at India. That's part of the problem we have.
They're not looking anywhere in India.
But I think if you look forward, I think if you have theoretically an NPA crisis or you have farm crisis because of some people are predicting the worst El Nino in many, many years. If things like that should play out and you're hedging against those risks, the private sector is definitely a safer place to be than public sector banks.
And on that entire El Nino risk, what's your view on consumption? Because, we were just coming out of a slow cycle for some of the FMCG names. Then you have the entire GST play that made the sector favorable. And then once again, when things started to look better, you've got commodity inflation back at play. How are you looking at consumption? What looks good within that basket?
So I think the big consumer names, staples, definitely benefit from an inflationary environment. They're able to absorb costs, they're able to pass on prices. So I think that is obvious. But to your point, I think what I've been saying, it might sound a little repetitive, but India as a whole, what I said of banks was true for India as a whole. We were in a little bit of an early cycle recovery play. And this has kind of put us, a spanner in the works, so to speak. So we'll have to see how so that's going to impact even consumption. We are all hoping that at some point the parties involved agree to a solution and therefore the strait opens up and we don't have this problem anymore. But if that doesn't happen, we are looking at those situations playing.
How do you look at power and renewable space? That's relatively untouched or impacted by this current crisis.
So I think it's very interesting, right? So I think if you look at the way the world, not just India, I think part of my job is to look at all across APAC. So I think the way, especially Europe, reacted to the 2022 oil spike their electricity prices just surged. I think they learned their lessons and moved on. So this time when oil has spiked, electricity prices have barely moved. They've gone up, but it's not like the big spikes that they saw in Europe, whatever. I think what this means for us as a country is that I think we are of course a lot more oil dependent and gas dependent in some of the areas. But we've also invested in a lot of renewables. I think there is a plan. While nothing has changed in terms of capex plans, it's too early. But I think it's safe to assume that India, like other countries, would want to kind of diversify away from oil dependence, import dependence, and look at things like thermal. We already have a pretty good nuclear situation for electricity generation. So we expect that across the world, we will see energy reliance, self-sustenance becoming a topic, and we don't see India being any different there.
Divya, the second order impact has so far been very muted on many of the companies. While we have the WPI inching above 8% at this point in time, but we've been able to absorb a lot of shock in the first 2 months. Do you think that there's enough resilience within the system and the economy to absorb further if this entire skirmish goes beyond May, June?
I would say the short answer is probably no. That's not just true for India. I think what's helped so far is that everybody's released reserves. If you look at oil, we've kind of quickly switched over to Russian oil. We've got oil from West Africa. Natural gas, we've gone up to North Africa. US fertilizer, sorry, not for fertilizer, nitrogen, we've gone to North Africa. For natural gas, we've gone to US. So I think we've kind of managed to diversify supply a little bit. LPG, there's probably some demand destruction that we have dealt with. So all of that has allowed us to postpone the problem. I think that's true of the entire world, right? The entire world, if you look at fertilizer in say, Europe, there was some regulatory change. There were some taxation changes. So people stocked up on fertilizer ahead of that. So therefore, suddenly it's not like everybody's scrambling for fertilizer supply. So it's helped stave off the problem for some time. But say end of the year, we're still in this situation. That's going to happen anyway, not just for us, but for everybody else as well.
Because from an oil point of view, if you compare it to what we saw during COVID, where there was demand destruction of nearly 15%, and we saw crude plunging to a negative territory. Here we have a supply disruption of 15 to 20%, but we haven't seen such a huge spike in crude.
Again, like I said, we've staved it off because people have released reserves, and people have found, like I think one of the biggest changes is that everybody is now free to buy Russian oil, right? And we've gone through other sources, whatever. At some point, if the oil remains where it is right now, maybe the US drills more. So we'll have to see how that plays out. But I think, like I said, there's a risk of sounding repetitive. We've managed, I think, to successfully stave off the problem or push the problem out for some more time. But it's not going to last forever.
Do you think it's a pivot for electrification within the country as well? Depending too much of energy, electrification will help because it's getting backed by renewable as well as the capacity builds up. And also from an industrial point of view and from a defense point of view, how do you see those sectors as well?
I think, so to take your first question first, we would definitely hope this spurs further electrification. I was joking in my office that I'm not worried about petrol prices because I bought an EV. But jokes apart, I think the reality is that you're going to see governments thinking very seriously about energy security and electrification through various means. I think in India, we'll have to fix our grids first, right? Or we have to upgrade our grids, and that's going to have its own challenges. So, but I suspect that's the way we will go. To the second part of your question, I'm sorry, could you repeat that for me?
On the industrial part, industrial sector and the defense, how do you see those sectors growing?
I think defense is a bit of a secular issue, right? What is very clear to us is that we are in an increasingly uncertain political setup. There's multipolarity and there's unexpected action going on in the world. So I think we will see any government, including ours, wanting to keep that spend relatively intact, even in circumstances where deficits are growing, because that's a need of the hour.
So when this war ends, as and when, and hopefully it does soon, which sectors do you think will bounce back the soonest?
I think the ones that are most impacted. Easy one there. But I think, look, what we don't expect is, like, if you look at our oil price forecast pre this, we were at $65 to the barrel. Currently, oil's at, today morning was at 110, maybe Brent. We don't think it immediately retraces back. So we're still going to be at about 85. That's our current house forecast. So it is, the markets may bounce, but the reality might not be that bouncy. If I
So how much longer for that to catch up?
So we'll need to see, like I said, for us, oil at 85 is still expensive. It's much more expensive than the 65, 70 we were at before. So I think we'll have to see. And in the middle, how much demand destruction happens and how much of that becomes a little bit more of a longer term problem. So we're seeing, say, pockets of rural, like I said, the worst case situation for us would be that this goes on for a long time and then we have a monsoon failure, right? So it's a little bit difficult to therefore say with confidence that you should be in this. I think I would, like I said, be a little bit more in resilient names, where you have, like I said, typical resilient names which you've discussed already, where your governments are going to spend more money. You're going to spend capex on defense. You're going to get the short cycle industrials, which my team led by Amit Mahavar likes, because the long term capex is now under question. Say if your GDP gets impacted, what happens to longer term, long cycle capex? The short cycle capex is already doing well, and that will continue because that's a near term inventory fulfillment here. So I think those kind of places where we see things kind of play out well, regardless of how the situation plays, I think was where we would like to be.
You know, valuation quadrant, you placed India with where upside is capped and downside there's no cap, you have kept it, while we have good structural growth fundamentals also playing out as a whole. What is keeping you from pushing the valuation pedal for India, aside of the AI trade and anti-AI trade which is working on globally?
But that is it, right? So if you, this framework needs to be seen in the context of how we view emerging markets as a whole. And our base case is that whatever is happening right now in the world, there is currently, it is not posing a risk to the AI trade in the US. And therefore, all the downstream beneficiaries, if you look at some of the memory stocks, and if you look, the 3 stocks literally that have delivered all the emerging market returns. And there is, that cycle is not slowing, doesn't look like it's slowing anytime now. So some of those things I think are the reasons why if you have significant, consistent earnings beats and upsides, and those stocks are not that expensive, when you put it in that framework, yeah, it does look like India does have some, like you said, fundamental strengths, but we don't have that kind of an earnings push. And when viewed against that backdrop, then valuations don't, they are more comfortable today. Before the bounce, they were a little bit more comfortable. But today, I would say we've bounced back reasonably well. So that valuation comfort is yet to come.
Divya, it was a pleasure talking to you today. Thank you very much for joining us on ET Now.
Thank you.
We'll step into a small break and we'll come back with more managements after this break.